Hello and welcome to NRHA's latest webcast. I am Dan Trottenchek. I am the publisher of Hardware Retailing Magazine and the Vice President of Publishing with the North American Retail Hardware Association. Today we're going to be talking about our annual report, Market Measure, which discusses the industry's activities throughout the year and forecasts for the future. This webcast is brought to you by the North American Retail Hardware Association, Hardware Retailing Magazine, and NRHA's Vendor Partner Program. What are we going to talk about today? Well, we're going to talk about two separate reports here. We're going to talk about the industry's annual report, which NRHA has been doing for decades now, and it's kind of like the scorecard for the industry, where we look at how retailers have been performing, different things that have had factors that have influenced the performance of retailers, and also we kind of give a forecast, a forward-looking view of what might be happening in the industry for the years to come. So more specifically, what are some things we're going to talk about today? We're going to be examining industry performance numbers and predictions. We're going to look at current sales by type of unit and unit counts, as well as predictions for how those sales and unit counts might change. We're going to discuss performance by the specific store types. And then we're going to discuss, as I said, industry trends and obstacles to that growth, or challenges that we might face on the way to get to where we want to be. Before we dive into all the numbers, I kind of want to give a little bit about our methodology for coming up with these numbers, because one of the most common questions we'll get here when we do our annual report or we do our cost of doing business study, which is a heavy influencer on the numbers that come out in our report, we get a lot of questions asking us, where do you come up with the numbers? Why are your numbers somewhat different from the government numbers or different numbers that I see out there? And the truth is, all the different organizations, whether it's ourselves, whether it's the Home Improvement Research Institute, NRHA Global Insights, or the numbers you see from the government, they all come from a slightly different set of data because we all look at the industry just a little bit differently. So that's what I want to characterize here, is how NRHA derives its numbers and what we look at specifically to come up with our forecasts. So how does our methodology work? Our numbers are determined using a specific set of data, and the data comes to us from a variety of sources, including our cost of doing business study. The cost of doing business study is something that we field each fall, where we ask retailers from across the country to give us their specific income statement and balance sheet information for the preceding year. One thing to note about this is each year the set of retailers that submit their data to us, and this is about 1,000 retailers across the country that give us the data, it is not always the same set of data. So we always caution people, when you look at that CODB data, to understand that you're looking at a different set of data. So you really want to monitor the trends, but not necessarily the specific movement item by item, because it is usually a different set of information that we get every year. So that factors into the numbers we're going to be presenting today pretty heavily. Another area that factors into the numbers pretty heavily that we're going to be presenting is the circulation research that we do here for our magazine, Hardware Retailing. Every year we invest quite literally 6 figures plus into making sure we are sending our magazine to every home center, hardware store, and lumberyard across the United States and in Canada. And to make sure that we're up to date on that list, and to make sure that we have all the information we can gather from those stores, we invest this money to do research. We call retailers, we send questionnaires to retailers, and that information yields quite a bit of data for us that we also factor into the study and to our estimates. Lastly, we use government statistics and wholesale sales. Both of these aren't necessarily a perfect predictor of how we derive our numbers, but they allow us to balance off of the other numbers we have, and it all kind of feeds into the overall image that we get of the industry. We also base our numbers, when we look at retailers and we look at the home improvement industry, we look at a particular set of retailers. We base our industry figure on the following types of sales. Sales at retail, so we're not looking at pro-to-pro sales. We're not looking at wholesale sales and counting those. We use wholesale sales as a factor, and we apply some formulas and multipliers to it to help us derive the retail sales number, but we don't look at wholesale sales included in our number. Sales through retail's primary business is selling hardware and home improvement goods, and sales through retailers who sell core categories within their stores. So after that, let's talk about what was the story of 2012, which is coming to a close rapidly right now, and you're probably watching this as we start 2013. Well, 2010 and 2011, and even going back to 2009, when we were writing our market measure wrap-up for those years, we had compared what the industry was going through to a car crash. We said, 1 year you're in the car crash, then you're assessing the damage. Well, now we've been able to take the car to the body shop and really get the full report. And what we really got in 2012 was a clearer look at the devastation that the economy and the market had wreaked on the industry, and it was worse than we had originally predicted. And as a result of some of the modified numbers coming in, we actually had to go back and revise some of our data for the years 2009 and 2010 to paint a little bit more accurate picture of the devastation that we thought we saw during those years. So that was the bad part. That bad part was behind us in 2012. Luckily, at that point, we were observers. That doesn't mean we still hadn't felt the blows, but we were at this point at least assessing the damage. But 2012 was, for the most part, a year of pretty good news for the home improvement industry. We saw the economy continue to strengthen, but there were still these outside forces that were really providing strong headwinds to the industry and not allowing us to reach our fullest potential. 2012, year over year from 2011, was a strong year for growth. We saw growth at about 4.3% year over year, but we still think if it weren't for these external headwinds, we could have seen a lot stronger growth for that period. So let's go back and look at 2009, 2010, and we'll talk about some of what we saw in 2011 and 2012 and how that played into where we ended up in 2012. 2009, 2010, as I said, we looked back, and there were some factors that we had to really carefully examine, particularly some of the data that came in from our CODB study, and look at that and project it against some other numbers to go back. And once the finals had come in, we were forced to revise some of our numbers down to even lower than we had originally predicted. So 2009 was revised down to $265.2 billion in annual sales for the industry, and 2010 was revised down to $269.9 billion for sales. So 2009 was certainly the trough for the industry. That was the low point, but it was actually a lower point than even we had predicted at the time. 2011, which a lot of the CODB data comes from 2011, so we're going to talk a little bit more extensively about that. In 2011, the results were actually stronger than we had predicted last year. We saw about a 3% increase year over year from 2010 for a final number of about $278.3 billion in sales. 2010, we thought we were getting over things. We thought we were on the way out, and we were on the way out. We were on the way out of the trough, but we were not recovering as quickly or as briskly as we had hoped we would be. And so that really set us back a little further in 2011 because we were starting from a little lower point than we had anticipated. Now, in 2012, the good news is we feel that we're seeing really sustained momentum that we could carry forward. So what are some of the positive influences that we saw in 2012? What were some of the good things that really drove our growth? Well, employment numbers kept rising. Also, we saw home building activity keep picking up. We started seeing housing starts begin picking up, and inventory on existing homes begin being eaten up. So our inventory on homes actually going out of 2012 was the lowest it had been in a number of years, which is all good news for home builders and home buyers. All of this, the positive news, the positive upticks in the employment and so on, created a positive momentum for consumer confidence. Banks also began lending again. I have personal stories about people I know that put their house up on the market and sold them within weeks. So it's all good news for the home improvement industry when the housing activity begins to pick up and the consumer confidence begins to pick up. For the most part in 2012, we saw a lot of uncertainty end up getting behind us, but I want to be cautionary about that, and we'll talk about that in a second. Let's take a look here real quick. I have some charts that I wanted to show you about how closely tied independent retailers and their home improvement sales are to the strength of the U.S. economy. And I think these are really interesting charts to look at here. The first chart I'm showing you is independent home improvement comp store sales growth versus housing starts. And if you look back at the trough, all the way back in 2009, when we were below the line on housing starts and we were seeing negative comp store sales growth on the independent sector, you could almost track direct correlation, and the correlation here is at 0.65%, but you can track direct correlation here to see that independent home improvement retailers' comp store sales almost directly mirror what's going on with housing starts. The next chart really shows the same kind of influence when you look at sales at independent home improvement stores versus consumer confidence index. It's almost exactly the same kind of correlation that you see. So when we talk about these other things going on in the economy, these larger macroeconomic factors, you can definitely see that they have a direct impact on how home improvement retailers, and in this case specifically independent home improvement retailers, sales tend to fluctuate. So I had alluded a little bit earlier to some of the headwinds that we saw for growth in 2012, but a lot of those are going to continue facing the industry as we move into 2013, and they're just things that I want to caution and consider when we have the discussion of where we have come from and where we're going to, and what are some of the things that may or may not inhibit our growth going forward. Well, one of the big things in 2012 that created some consternation for home improvement retailers were the changing weather models that we're seeing. We started off the year with an unusually warm winter in most parts of the country. So from that perspective, we lost a lot of sales early in the year because you weren't selling ice melt, you weren't selling as many snow blowers or snow shovels. However, the early winter, or the light winter, gave way to an early spring, and so retailers were really encouraged at the end of the first quarter and going into the second quarter that sales were going to be brisk. But what we found out was a lot of those early season sales kind of cannibalized sales later in the year, particularly with the stiflingly hot summer that we had in a lot of areas of the country that just didn't prompt people to want to get out and do as much work on their yards. Even with all those things, we still had a strong year, but these changing weather patterns now late in the years with some of the tropical storms we had early in the season, and then with Hurricane Sandy kind of putting an exclamation point at the end of the season, as an industry, we're going to have to do a better job of trying to figure out what these new weather patterns are and how they'll influence not only the selling but the buying as well, so we can try and have a better understanding of how to buy products, when to buy them, and when the seasons might end up falling out. Now, a lot of that remains to be seen, and if there was some way to predict the weather more accurately, I don't think we'd be selling hardware. We might be doing something else for a living. Other things that are creating uncertainty and headwinds as we move forward are global issues. Again, these macroeconomic issues, what's going on with the economy in Europe, what's going on in Iran, all those different things that, although we don't think they might necessarily directly influence the home improvement industry, if you refer back to the charts I was showing just a minute ago about how closely sales are tied to things like overall consumer confidence and housing starts, if there is trouble abroad, if there is trouble with the economy, if the stock market can't hold, then consumer confidence is affected, and those kind of things affect buying and selling. So a lot of our predictions and where we think we're headed, I would just caution again, all bets are off should something dramatic happen on the global stage. Something else that we need to consider is the role of inflation going forward. As the economy picks up steam, depending on what we also see going on in Washington and with some of the governmental gridlock, if we can break through that, all these different things, what's going on at the Fed, quantitative easing, all those kind of things will have an impact with inflation. Now, inflation has been tamed for the last several years, but we really want to be considering what might happen with inflation as we move forward and how that might impact the industry. And that's just kind of one of the uncertainties right now that could have, again, a dramatic impact on our growth as we move forward. Another thing that will impact sales, and maybe not sales in terms of how much is being purchased, but how and where it's being purchased, are changing consumer habits and the way consumers are living their lives. Now that really kind of runs the gamut from how today's household is changing, the makeup of the household, who the head of household is, and what the buying patterns are, but it also goes into consumers' habits in terms of savings, in terms of ability and willingness to take on credit, and something else that's kind of dangerous out there that a lot of us are beginning to identify or beginning to talk about is what we feel is the next bubble that could potentially burst. We had the tech bubble, then we had the housing bubble, and the other one that's out there right now that's looming very closely on the horizon is the student loan bubble. You have a lot of the young people that are beginning to get to the age where would traditionally enter the housing market and move on to the next phase of their life, that are strapped with tens of thousands of dollars in student loan debt, which might be deferring their purchases for homes, which would in turn defer their home improvement purchases, and right now there isn't really a good plan on the table of how, from an economic standpoint, we can deal with those issues. And it's something that's going to be on us here. It's already on us, but it's going to be more of a factor as we move into the next 5-year period. So let's talk specifically about what some of the growth areas we saw in 2012 and some of the growth areas within the industry that we think we'll see again as we're moving into 2013. Well, home repair and maintenance activity was really what had propped up the industry, particularly the independent segment of the industry during the difficult times of the recession. What we said back then was you might not be remodeling your home or buying a new home, but you certainly still needed to fix your toilet if it broke, and you might be doing smaller projects that you wouldn't normally consider part of a remodel, things like painting rooms and adding hardware in the kitchen and things like that. Well, what we started to see in 2012 and what we think will continue momentum in 2013 is that we're going to see home repair and maintenance activity still remain strong, but we're going to continue to see a transition from home repair and maintenance as the primary driver of purchases to home repair and maintenance activity along with small projects beginning to move more to the forefront. As the housing market loosens up, as credit becomes more available, as more homeowners feel as if they have a clear path to the direction they're going to go with their homes, we feel that you're going to start seeing more small-scale remodeling projects factor into what we see expenditures in the home improvement industry, the direction they're going. What I mean by that, what we think is you might not still see the return of the $25,000, $50,000 kitchen remodels, but you're going to see more remodeling projects in that $10,000 and under area. A lot of those projects that don't necessarily need to be financed by home equity, but can be financed by consumer credit or by anything from a tax return to year-end bonuses as companies begin doing better. Some of the other areas where we see some growth are home aesthetic related areas, areas like outdoor living, areas that add comfort to the homes that don't necessarily require an entire remodel. We really saw that strengthen in 2012, and we really think that that fashion and that aesthetic is going to drive purchases into 2013. We also think in 2013 you can look for more transitional home improvement product sales as more first-time home buyers move into houses and more housing activity begins to gin up and more houses are sold, because as we all know, the majority of home improvement expenses get done during the first 3 months of either prior to selling a house or after moving into a new house. As far as categories, the biggest winner continues to be, and one of the areas where we continue to see growth even through the recession, is in the rural living and pet and ranch categories. This is exemplified certainly by some of the big players in the industry, Tractor Supply Company and their growth, but also with some of the smaller retailers out there that have still managed to grow, and even categories within more traditional home improvement stores. As more consumers try and get away from the suburbs and the city life, and they're seeking that kind of rural living ideal, they're looking for that for the products that support that lifestyle, and that's really showed in that category. So let's talk a little bit more about what we think lies ahead. As I've said a couple times, we are predicting a period of moderate sustained growth for the industry. Barring any outside influencers that can impact the overall economy, we think that the home improvement industry should continue along the strong but moderate growth track that we've seen over the last year or two. As unemployment continues to fall, look for energized housing activity. The last thing we want to say about what we predict is we certainly don't predict we're going to at any time, at least within the next 5 years, return to the same kind of boom activity that we saw in the late 90s. Double-digit growth is still a ways off for this industry, and we are predicting strong growth, but in the low single digits, below 5%, and we'll look specifically at that as we go here. 2011, 2012, the numbers are up there. What we saw growth in our predictions for 2013, 14, and 15 moving forward. Again, we see 2014 and 2015, some sustained growth and some strong year-over-year growth in those years, and that's when we think that the housing market will really be hitting its full clip. Just to give you a little other perspective, we also look at the numbers from the Home Improvement Research Institute, IHS Global Insights, and they're really tracking, although the numbers are slightly different from ours, the pattern tracks really along the same kind of course as moderate sustained growth, when the years and the period between 2014 and 2015 really seeing the bulk of that growth, as they believe as well that the housing market will be running at full steam at that point. So 2006, 2011, we actually saw negative growth within the industry of about 1%, and we're predicting 2011 to 2016 that we're going to see sustained moderate growth, 4.1% compound for that period. We also think, as I said earlier, were it not for the external headwinds in 2012, growth in home improvement might have been even stronger than it was. And we really think that 2012 was the pivotal tipping point. Not that that 2009 to 2010 wasn't also an important era in the process, but 2009 to 2010 was when we turned the corner. I think 2012 was when we really started heading back and saying we could at least not be as quite concerned about whether this was really happening or whether it was a temporary situation. I think 2012 proved that we are in a solid situation, barring any dramatic outside influences. You're not also, and it's also important, you're really not hearing any more talk about a double dip recession, except from some of the fringes that typically want to cast up those kind of warnings. So what do we have looking forward? What are we going to talk about that is impacting the industry? What are some of the things going on that aren't necessarily so tied to the economy, but are just things that are going on in the industry that we want to watch as we move forward? One of the big things that has really been of interest to us and our editors and analysts here at NRHA is the changing role of the big boxes. Not only have the changes in the economy and the changes in the way consumers shopped really impacted the big box industry, not just in home improvement, but certainly across the retailing landscape, and the way consumers perceive their big box shopping experience. We're going to want to continue to look at that. Within the big boxes that are in our industry, Home Depot, Lowe's, and Menards, there's been a lot of jockeying back and forth for leadership position. For a long time, it seemed like Lowe's was really charging hard at Home Depot, who was certainly the incumbent leader going into the recession. And we all wondered as we went into the recession how that would change when we came out of it. Well, what we really saw and what began to take shape was that Lowe's actually lost some ground to Home Depot. There were a number of things that happened at Lowe's, certainly some of the early PR stumbles that they had coming out of the recession, but also some of Home Depot's efforts, and credit to Home Depot for investing a lot of money and resources into improving things like their logistics, improving things like their customer service in store, that really caused Home Depot to put some further distance between themselves and Lowe's. Now Menards is always ever present, certainly from their contribution to sales in the industry, but let's not forget Menards is still a regional player. But what really helped Menards, certainly through the recession, was that their brand and their focus is built around low prices. And that low price image really resonated well with consumers. In the last year or so, Menards has also started trying to change their image and change that brand a little bit more to get away from low prices at all costs, which to many meant cheap imported products, to low prices with a lot of quality products. I'm sure you've probably noticed a lot of their commercials, and they've had Made in America days, and they're promoting more brand, and that their products are also of quality as well as being low price. So it'll be interesting to see how the big boxes continue to jockey as we move forward. The other interesting kind of element that gets thrown into that is the role of online retailers. Specifically, Amazon is kind of the 800-pound gorilla in the room that all retailers, particularly the national retailers at the big box level, are concerned and wondering what kind of impact that is going to have on as consumers continue to change their shopping experiences. Online purchases within this industry continue to grow. Certainly, online research for information continues to grow, and not that all retailers aren't worried about it, but the impact will be more immediately felt by the retailers at the national stage. Less volatile business conditions across retail types also created more parity. Not just the outside influences, but also the internal influences. Home Depot and Lowe's, as the recession dawned, stopped their manifest expansion, if you will, and they started looking more inwardly into things like expense controls. In the lumber and home building industry, obviously, as the housing market began crashing, retailers were so busy making cuts and trying to figure out how to survive, they weren't really able to focus on growth for the business, certainly, but on any sort of innovation or any model changes or brand efforts. Well, that's beginning to change, and I think we're going to continue to see that because the business climate has somewhat somewhat stabilized. What we saw, and we'll talk a little bit later on when we talk more specifically about store type performance, is that customer counts at home improvement stores, we are seeing return to their pre-recession levels at building-oriented stores, at home centers and lumberyards. So that again is encouraging, and we think that increased activity, not only did we really started seeing it in the 2011 numbers, but we're going to continue to see that impacting the numbers as we move forward. Let's take a minute and talk about store type performance. And again, I wanted to set the stage a little bit when we talk about store type performance to talk a little bit about how we define the different store types, because this is another one of the typical questions we get. What do you guys call a hardware store versus what you call a home center or a lumberyard? And it's pretty, we have a pretty good method for determining what store type is which, and I'll talk about that here for just a moment. A hardware store. We define a hardware store as a business whose primary business is selling hardware and home improvement items. That seems logical. A hardware store, by our definition, should carry all of the core categories within home improvement. A hardware store offers little lumber and building materials. They may have a convenience building material assortment, but they certainly don't have any kind of lumber yard or serious outside storage where they would keep those kind of products. There are no size limitations or sales limitations for a hardware store. You could have a $10 million hardware store. You could have a 40,000 square foot hardware store, because that's not how we define the difference between a hardware store and a home center. A home center, to kind of explain what I mean by that, is a hybrid of a hardware store and a lumberyard. By our definition, to define something as a home center, it has to have a minimum of a 10,000 square foot under roof sales area. It has to carry a full assortment of hard lines as well as lumber, and this does include big boxes for the position of our overall industry numbers. When we look at the store type specifically, we're only looking at independent numbers, but when we talk about home centers in our industry for store counts and overall sales, that does include the big box numbers. So going back for a moment to the difference between a hardware store and a home center, it's not certainly size alone. Like I said, you could have a 40,000 square foot hardware store, but if they do not carry a significant amount of lumber and building materials, then they would not be classified as a home center. Lumberyards can be a chain or independent. They allow, the ones we look at allow consumer traffic. And lumberyards, obviously, they have a significant portion of their sales that come from lumber and building materials, but they also have a sales floor under 10,000 square feet. And that's really how we see the difference between a home center and a lumberyard. If someplace has a 40,000 square foot store, under roof sales floor, and lumber and building materials, we would classify that as a home center. So let's look at sales by store type and how that's changed and how we see it going into the future. The numbers kind of speak for themselves there. We see stronger growth coming first from home centers and then following into lumberyards as the housing market picks up. Home repair and maintenance purchases have propped up hardware stores over the last few years and really made the impact of the recession not as hard on those types of stores, because those are the stores that really have their bread and butter from home repair and maintenance and didn't see as big a drop off. That's not to suggest in any way that there weren't a lot of hardware stores that were very hard hit by the economy, but because they were less tied to building and remodeling activity, they didn't feel the same kind of purge that you would say at a lumber dealer. What we saw in 2011 going to 2012, that lumber dealers and home centers really got back in the game when it came to growth, and really got back in the game with customer counts and other metrics that we look at, showing that they have made it through the recession and are starting to begin a period of growth yet again. Number of outlets, again, you can see how they have changed throughout the years. One thing that's important to point out, because this is, again, is one of the typical inquiries that we'll have here, is how many stores go out of business on an annual basis. And it is true that through the recession, prior to the recession, even during the boom years, we were seeing a steady attrition in the overall number of stores. Now, as Home Depot and Lowe's continued to build stores in the hundreds every year, that would drive up the home center number. But overall, as an industry, we saw a slow attrition of stores, and we think that attrition of stores is going to continue as consolidation continues. And like you can see by the numbers up here, it's not necessarily a dramatic decrease. Take hardware stores, for instance. We only think we're going to see an decrease of about 40 stores over a 3-year period. However, the number continues to go down And whether or not that's troubling kind of remains to be seen, because it is also just a reflection of the different ways we're kind of living our lives as consumers, in that there's a strong suburban presence, there's a rural presence, but there's probably a lesser need for as many stores in the industry as there once was, because the consolidation of our living spaces and the consolidation of where our population is concentrated. The top chains within the industry, what we're looking at here is their top chains' overall contribution, and what we do is we look at the top 10 chains that fit the models that we look at, and that we think are comparable to the bulk of the stores that we look at. So stores selling home repair and maintenance, home centers, and so on. And we look at their performance as a percentage of the industry. In 2011, 49.1% of the overall sales for the industry came from the top 10 chains. As a percentage of the number of units, those top 10 chains accounted for about 13.8% of the overall number of stores within the industry. What that clearly shows is, and I'll tell you that the number 49.1%, about 44% of that comes from the big three, comes from Home Depot, Lowe's, and Menards. The rest of it is a collection of the other chains that would be on the top of that list. And the bulk of the store count in that 13.8% comes from Home Depot, Lowe's, and Menards as well. But what that shows you is that beyond that 49.1%, first of all, it indicates that the majority of sales within in the industry are still controlled by the independent dealers in the market space. These are the Aces, the True Values, the Do It Best stores affiliated with other wholesalers and truly independent stores, some of the farm and ranch stores that are kind of hybrids, home improvement, farm and ranch, all these other retail outlets that make up the remainder of that 51%. They contribute that. So it's still a highly fragmented marketplace. But one thing that we have seen since prior to the recession, we saw the top chains continuing to take a larger and larger percentage of industry sales, and that number reversed several years ago. And in fact, from 2007 to 2011, the percentage of industry sales controlled by the top chains has dropped by nearly 2%. However, the unit count of those stores has really remained about unchanged during that same period. All right, let's look specifically at some of the store models and see how they're getting to profits and how they're performing. This data comes from our cost of doing business study that I referenced earlier. As far as hardware stores go, what we have here are the average stores and then the high profit stores. And the high profit stores we define by looking at the top 25% by their profitability. And in the past several years, what we saw was a pretty distinct difference. We saw a growing gap between the winners and losers. And what I mean by that is we saw the amount of space between the average store and a high profit store becoming greater and greater, showing that there had really been a culling of the retailers who could figure out how to navigate the difficult economic times and the ones that were slow to adapt and slow to change to the new environment. But let's take specifically a look at how they did in 2011. Well, average sales at the respondents that we got for our 2011 study at an average store were about 1.3 million and about 1.6 million at a high profit store. Big difference here in gross margin. The high profit store was generating about 43 points versus about 42 points for an average store. Roughly the same size selling area. High profit stores generating more sales per square foot. Stocking actually slightly less inventory per square foot, but what that suggests is that the inventory they have selected is either carrying better margins or it's more productive. A big area that really began to develop and really show the difference between winners and losers after the recession was on the expense side. And as you see here, there's about 4.5% difference between a high profit store and average store, which at the bottom creates a pretty big noticeable difference when you apply all these things together. The average store had a profit before taxes of about 1.5% of sales, while a high profit hardware store was turning almost a 7.5% profit. There was no real one area, again, this year that was the major difference between a high profit and average store. Some of the areas that we thought were notable to point out was that the higher profit stores saw a dramatically higher customer count, about 86,000 per year versus about 78,000 per year at the average store. So they're able to, through a variety of ways, attract more business through their doors. Once they get those customers in, they were also actually able to get an extra dollar out of their pockets, generating a higher average transaction, about 18 to versus 17. The slightly higher gross margin at 43.4 versus 41.9 meant that for those $18, they're keeping more of that money. And that means they're buying their products better, and they're buying products that offer better margin opportunities. They're also getting better turns. They're turning that inventory more quickly, 2.3 times versus 1.9 times at the average store. Bottom line also is dramatically affected by their tighter expense controls. So that's what we saw driving the difference and driving high profit hardware stores in 2011. Let's take for a quick look at home centers here for a minute. And as I said, please note these numbers from the CODB do not include the big boxes, but our overall national numbers do include the big boxes. When we look at specific unit performance, we think we want to compare apples to apples and let the independent home centers get a much more clear example of how they stack up instead of wrapping the big box numbers into that. High profit stores slightly higher on their average sales. Gross margin actually slightly lower, a little bit larger selling area, a little bit lower inventory per square foot. Total operating expenses, however, again, the same kind of story there, 32.1% at an average store versus 27.1% at a high profit store, generating a profit at the bottom line of about 1.5%, very similar to the average hardware store at a home center, but high profit stores are only generating about 4.5%. Now, as I said, the group of stores that we look at year over year for our cost of doing business study changes because we get different sets of respondents who send in the data for us to look at. So you can't necessarily use that data to say that home centers, the specific home centers we looked at saw sales increases. But we do look at group versus group. And the group that we looked at in 2011, the sales they reported was up pretty dramatically over the group in 2010 by about 18%. Customer counts were also up dramatically. 2011, we saw customer counts of 98,000 versus about 85,500 versus 2010. This was even stronger customer counts at the high performance retailers where we saw about 104,000 customers going through those doors every year. Inventory turns for the home centers we looked at in 2011 were also up over the group of 2010, 2.9 times to 2.3 times in 2010. So what that suggests to us is that more customers are shopping at the home centers in 2011 than we saw in 2010, which leads us to believe that more customers are looking for the higher ticket projects, and more customers are looking for the projects that home centers are known for selling. Lastly, just like with hardware stores, the high profit retailers and home centers kept tighter expenses, 27.1% for the average store versus 27.1% for the high profit store versus 32.1% for the average store. Lumber dealers, and I will say right up front that lumber dealers were one of the areas that saw the biggest diversity between the average store and the high profit store. So what that suggests to us is that lumber dealers who have managed to make their way through the recession have really figured out a profit model that is working for them. And let's take a look at some of the specifics here. The average sales at a high profit store, about 3.5 million versus about 2.9 million at an average store. Gross margin about 36.6% at a high profit store versus about 32.5% at an average store. Selling area roughly the same. Sales per square foot, however, the high profit store is generating almost $250 more sales per square foot than an average store. They've got slightly higher inventory per square foot, and they're much better at managing their expenses. And what that does on the bottom line is create an 8-point difference. Profit before taxes in an average store, 1.6% versus 9.6% at a high profit store. As I said earlier, the lumber dealers showed the highest gap between the average stores and the high profit stores. We saw customer counts return to pre-recession levels at lumber dealers. Dramatically increased consumer business at lumber yards too. We saw in 2010 the number of consumers going to the consumer business at the average lumber yard we looked at was about 22%. In 2011 that had risen to 30%. And we think that's a direct result of as business on the building side began to taper off, a lot of lumber yards began looking for ways to revamp their sales floors, add categories, redo their operations to draw in more consumer traffic, and that's began to pay dividends in 2011. Further evidence of that contributing directly to the profitability model is that the high profit performers in our study also did more business with consumers than the average did. High profits did 35% of their business with consumers versus 30% at the average store. Something else that was interesting to point out on the lumber dealer side is the cost of goods sold at the high performance dealers was a full 3% lower than it was at the average dealer. So they're buying products better and they're managing their operations better. So after we've looked at the store types, after we've looked kind of at a more macro view of the industry and the economy, what are some of the conclusions, things you can take away from our report here? 2011 and 2012 both were good for the home improvement industry. They both signaled a continued growth and showed that the industry is on a march upward. Again, 2011, we were still a little bit unsure. There were still a lot of things that were dragging us back. Not that those things didn't exist in 2012, but we saw marked recovery on the economy, which translated to better sales and better positioning for the home improvement industry. We also think 2012 could have been more of a breakout year were it not for some of the macroeconomic concerns that provided strong headwinds for the industry. We think through 2013 through 2016 we should see a period of sustained growth, with 2014 and 2015 really being a turning point when we think housing activity will be buzzing at its fullest. We're now realizing what the new normal is within this industry, and we think that new normal is much more on pace with that moderate, low, single-digit growth, certainly than with the double-digit growth we were seeing in the 90s. But for right now, as long as inflation remains in check, we think that 4%, 5% growth that we think we're going to see for the next 5 years is going to carry the industry forward and mean good things for the home improvement industry. I'd like to thank you all for watching our webcast today. Again, I'm Dan Trottenchek, and we appreciate you continuing to read our magazine. And please let us know at NRHA if there's anything we can ever do for you. Thank you.